what the new principal limit factors mean for you and the industry. Welcome to the Industry Leader Update by Reverse Focus. Last Friday we saw two watershed events for the federally insured reverse mortgage program: revised principal limit factor tables and the inclusion of younger non-borrowing spouses under the age of 62. First, a little background. The pace of change to the HECM program has been rapidly accelerating, with FHA's new authority to make substantial change via mortgagee letter. This versus the lengthy rulemaking process. In other words, FHA and HUD can act quickly to modify the reverse mortgage program as they see fit. Second, the displacement of non-borrowing spouses has been a thorn in our collective side and also a ready source of negative news stories which featured elderly individuals being foreclosed upon. In light of these two factors, HUD released new principal limit factor tables, which do go into effect August 4th. Now first, the good news. Younger borrowers 62 to 74 will see a modest increase in proceeds up to the effective interest rate of 5.87%. Older borrowers over 75 will see a market improvement in available proceeds, with an 85-year-old receiving approximately 10% more in proceeds at the 5% effective rate. Now the bad news. The Consumer Financial Protection Bureau's report to Congress on the HECM program highlighted the new trend for retirees to take the HECM at younger ages. FHA is anticipating the impact of rising interest rates and also the trend toward younger borrowers, and they seek to mitigate that risk with rapidly growing loan balances. Now, one could surmise that they seek to reduce such a risk by substantially reducing the principal limit ratios or factors as seen in this chart provided by IBIS software. It is clear that we're still in the midst of a historically low and artificially manipulated interest rate environment in the wake of a housing and economic crash. What may be good news today will be a bitter pill to swallow in the future, as interest rates will certainly rise. Which brings us to another important point: the cost of waiting. In light of the new PLF tables, which are weighted against younger borrowers, the case of a standby reverse mortgage has never been stronger. For example, assuming a 0% appreciation rate, a 64-year-old with a $300,000 home at a 5.37% rate would get $146,000 this August. Now, if he were to wait until age 70 and the effective interest rate was 7.25%, his proceeds would only be $104,000. That's a 29% decrease, not to mention the loss of growing a larger unused line of credit if taken at 64. FHA has re-engineered the HECM program to possibly discourage younger retirees from taking the loan in favor of waiting. Now, in light of these changes, we should always advise potential borrowers of their true options. Now, what is your take on the new PLF tables? Share your comments in the comment section below and have a great week.